Supply and demand. Supply and demand zones are areas where price made a strong move away from a level. If price exploded upward from a zone, that area may later act as demand. If price dropped aggressively from a zone, that area may later act as supply. Many traders also refer to these zones as order blocks. Just like support and resistance, these areas are often treated as important zones where price may react again. Candlestick patterns. Candlestick patterns are used to analyze possible future price movement by reading the shape of individual candles. Some of the most common examples include engulfing candles, hammers, shooting stars, and dojis. An engulfing pattern can show strong momentum. A hammer or shooting star can show rejection. And a doji often shows hesitation or indecision in the market. These patterns are often used as entry confirmation when they form at an important price level. Support and resistance. Support and resistance are horizontal price levels where the market has reacted before. A support level is found below the current price and acts as an area where buyers may step in. A resistance level is found above the current price and acts as an area where sellers may step in. Since price has already respected these levels in the past, traders often use them as possible zones for future reactions. Fair value gap. A fair value gap is a price imbalance created when the market moves aggressively and leaves a gap between candles. To identify it, traders usually look for a large impulsive candle and then mark the space between the wick of the candle before it and the wick of the candle after it. This area can later act as a magnet for price. The idea is that the market may come back to that imbalance before continuing in its original direction. Fibonacci Retracement. Fibonacci retracement is a tool that plots horizontal levels based on Fibonacci ratios. Traders usually apply it by identifying a swing low and a swing high, then drawing the tool between those 2 points. Once the tool is placed, it highlights levels where price may pull back before continuing in the original direction. Some of the most watched levels are 0.382, 0.5, and 0.618. Many traders pay close attention to the 0.382 level because shallow retracements often reverse from there in strong trends. Harmonic Patterns. Harmonic patterns are advanced chart formations based on very specific Fibonacci measurements. These patterns are used to predict future price movement by checking whether price swings match certain ratios. Examples include the bat, butterfly, and crab patterns. Each of them has its own structure and Fibonacci requirements. If the price action matches the pattern correctly, traders may use the final completion zone as a possible entry area. Elliott Wave. Elliott Wave is a theory that says the market tends to move in repeating wave cycles. A classic Elliott Wave structure consists of 5 waves in the trend direction, followed by 3 corrective waves in the opposite direction. These waves are often labeled 1, 2, 3, 4, 5, and then A, B, and C. Traders use this concept to estimate where the market may be within a broader cycle and where price could move next. There are also rules that help validate whether a wave structure is legitimate. First, Wave 2 cannot retrace beyond the starting point of Wave 1, and it often pulls back to around the 0.618 Fibonacci level. Second, Wave 3 can never be the shortest wave among Waves 1, 3, and 5, and in many cases, it is the strongest and longest wave in the sequence. Third, Wave 4 must stay above the top of Wave 1 in a bullish structure, and it often retraces to around the 0.382 Fibonacci level before the trend continues. Oscillators. Oscillators are indicators that measure the relative strength of price and are often more useful in sideways or choppy markets. 2 of the most common oscillators are RSI and stochastic. If RSI moves into the oversold area, traders may start looking for a move upward. If it enters the overbought area, traders may expect a move downward. The same concept applies to stochastic, where traders look at extreme levels and crossovers for possible reversal signals. Divergence. Divergence happens when price and an indicator begin to move in opposite directions. For example, if price is making higher highs but the indicator is making lower highs, that could be bearish divergence. This may suggest that momentum is weakening even though price is still rising. The same idea works in reverse for bullish divergence. Traders often use divergence with indicators like MACD, RSI, or stochastic to anticipate possible reversals. Heikin Ashi. Heikin Ashi is a chart type that replaces standard candlesticks with modified candles. Its purpose is to reduce noise and make trends easier to see. A series of green Heikin Ashi candles usually reflects bullish trend conditions. A series of red candles usually reflects bearish trend conditions. The larger the candle body, the stronger the trend tends to appear. However, it is important to remember that Heikin Ashi does not show the exact real market price the same way regular candlesticks do. Renko. Renko is another chart type that filters out market noise. Unlike normal candlesticks, which form based on time, Renko blocks form only when price moves a certain amount. For example, if the Renko setting is based on a 1% move, a new block will only appear after price changes by 1%. This makes trends easier to read. Green blocks suggest bullish movement, while red blocks suggest bearish movement. Just like Heikin Ashi, Renko is useful for visual clarity, but it does not display price in the same raw way as a normal candlestick chart. Volume indicators. Volume indicators help traders understand how much activity is behind a price move. Instead of only looking at where price is going, they show how much participation is involved in that movement. Examples include regular volume bars, VWAP, and volume profile. Volume bars show how much was traded during each candle. VWAP gives an average price based on both price and volume. Volume profile shows where the most volume was traded at specific price levels. These tools are often used to confirm the strength behind market movement. Momentum indicators. Momentum indicators are tools that help measure the direction and strength of a trend. They work best when the market is clearly trending. Some common examples are MACD, moving averages, parabolic SAR, and super trend. For example, if price is above a moving average, many traders see that as a bullish sign. If price is below it, that can suggest bearish conditions. These indicators are often used to help traders stay aligned with the direction of the market. Trend lines. Trend lines are diagonal levels that traders draw to follow the direction of the market. In an uptrend, a trend line is usually drawn below price by connecting higher lows. In a downtrend, it is drawn above price by connecting lower highs. Trend lines can help traders identify the trend direction, and they can also be used to find possible entries when price retraces back into the line. Many traders like trend lines because they are simple to use and easy to combine with other concepts. For example, if a trend line lines up with support or demand, that area may become even more interesting for traders. It's usually called an area of high confluence. Breakout patterns. Breakout patterns appear when price spends some time consolidating, then suddenly moves strongly in one direction. This kind of move is called a breakout. Before the breakout happens, the market often forms recognizable shapes such as triangles, wedges, or rectangles. Traders watch these formations because they can help identify a breakout before the market makes the actual move. Reversal patterns. Reversal patterns are chart formations that suggest the market may be preparing to move against the current trend. Some of the most well-known reversal patterns are double tops, double bottoms, triple tops, triple bottoms, head and shoulders, and cup and handle. These patterns are used by traders to spot possible turning points in the market before the reversal fully develops. Market structure. Market structure is the way traders read the overall behavior of price. It helps you understand whether the market is moving higher, moving lower, or simply ranging. When price forms higher highs and higher lows, that is considered an uptrend. When price forms lower highs and lower lows, that is considered a downtrend. This is one of the most important concepts in trading because before using any tool, you first need to know what kind of market you are dealing with. Break of structure. A break of structure happens when price breaks a previous swing point in the direction of the current trend. For example, in a bullish market, if price breaks above the previous high, that can be considered a bullish break of structure. In a bearish market, when price breaks below the previous low, that is considered a bearish break of structure. This tells traders that the trend may still be continuing. That is why break of structure is often used as a confirmation of trend continuation. Change of character. A change of character happens when price breaks a key swing point against the current trend. For example, if the market was forming higher highs and higher lows, but then suddenly breaks a previous low, that may signal a possible shift in direction. On the other hand, if the market was forming lower highs and lower lows, but then suddenly breaks a previous high, that may signal a possible shift in direction as well. Because of this, change of character is commonly used as an early warning sign of a reversal. Moon phases. Moon phases are one of the more unconventional concepts in trading. This idea is based on the belief that lunar cycles may influence human behavior and, as a result, market sentiment. Some traders associate the new moon with bullish conditions and the full moon with bearish conditions. Today, this concept is mostly used as a secondary confirmation tool rather than a primary method of analysis. Gann Angles. Gann Angles are a tool made up of multiple diagonal lines projected from a key point on the chart. These lines are used to measure trend direction, trend strength, and possible support or resistance zones. When price moves along steeper angles, that can suggest stronger momentum. When it moves along shallower angles, the trend may be weaker. Although it is a more old-school tool, some traders still use Gann Angles to study how price behaves over time and angle. Dynamic support and resistance. Dynamic support and resistance is very similar to regular support and resistance. But instead of drawing static horizontal lines on the chart, we use tools like the moving average as our key level. Because this level moves together with price, it is called dynamic support and resistance. This concept is especially useful when the market is trending, since price often reacts to these moving levels before continuing in the same direction.